Welcome back to Markets Today. It's the first day of December, and we have been having a couple of conversations looking at topical issues that are affecting or could possibly affect the outlook for Kenya in terms of looking at its investment case. Last week, we had an overview of the debt situation, and this was in line with the public hearings concerning the budget outlook. Now, today we want to continue this conversation on debt and to understand what is the debt situation? Should we be concerned or are we overthinking this? But more importantly, how do we compare to our peers across the continent? Mr. Ken Gishinga is joining us for this conversation. He is the chief economist at Mentoria Economics. Karibu sana, Mr. Gishinga.
Thanks for having me.
So you are an economist. So even before I start getting into debt, when you look at the country of Kenya today, I know you have been looking at it for a very long time. Are we in a good place? Are we getting better? Are we still going to keep saying that COVID-19 is making it worse for us? Or how should we look at ourselves from an economic standpoint?
When I think about the Kenyan economy, it reminds me of Kenya in the early 90s when our debt situation was not very good. At that time, the IMF and the World Bank had to come in, and we had these structural adjustment programs that came in and really liberalized the economy, but still it was a painful transition. When I see the IMF and the World Bank heavily involved in Kenya now, it reminds me of those days, and it tells me if we don't watch out, most likely we are going to go into some of these structural adjustment programs, which can tend to weigh heavily on the Kenyan economy.
Okay, and it's interesting that you say that because if we look at the continent, there has been a similar point of caution coming through from countries such as Nigeria, which is one of the larger countries in the continent of Africa. And the aversion is, if we listen too much to the external partners, there's the element of going back to the structural adjustment programs, which are not good. What would be the worst thing that could happen? What is the worst thing that happened in the 90s, and what's the possible read-through for us where we are at today?
Well, if you go back to the 90s, the country was forced to make major reforms. The reforms weren't necessarily bad, but the speed upon which they were implemented. Anytime you have major changes in a short period, it can be very painful because the labor market is not as dynamic as it needs to be. So we saw the liberalization of the Kenyan economy, which had its benefits. We saw a vibrant private sector that came up in the 90s. And I see another round of privatizations coming up. So when we think about the Kenya powers, all these things, I really feel if we do not watch our debt profile very well, we might go the Zambia way. And what Zambia is right now is having those conversations with IMF, which will really impact how the Zambian economy will be playing out. So it can be a painful process. Some people say it's a necessary shift, but sometimes, just thinking of what Kenya went through in the 90s, one sort of cringes a bit.
Okay. All right, fair enough. So we're not in a good place, but we need to be cautious in terms of who are we listening to and what policies are we implementing. All right, now let's take a look at debt. But just before we take a look at debt, maybe you can briefly give us your views on GDP and the growth outlook, because the numbers don't look good, the negative, the last growth numbers that we saw. And even when you get to the ground level, the economy has opened up, but you're not necessarily feeling the liquidity. There's not too much cash that's circulating. The business opportunities are not as vibrant, or they're not what we were used to. People have been forced to change. So from where you stand, are you concerned? We're getting into an election cycle. We have to go through BBI referendum. Is it a good time for us, or are there shaky waters?
It is a time for concern, and I spend a lot of time on the ground talking to business people. And indeed, cash in circulation has taken a huge hit because the containment measures meant a lot of businesses had to shut down. So jobs have been lost. And then when people are out of jobs, their spending patterns really change. And they tend to hold back a lot more and not really spend. So we're seeing cash in circulation. The demand for money is quite low. And that has a big impact on the money supply around the economy. So it's something we should be worried about because, as you said, the contraction, the latest World Bank numbers, we're talking about a 1% contraction for the full year. Obviously, the Q2 numbers were much worse, but the full year, I think it's negative. So I think for me, it's two things. It's a time for concern, yes, in terms of money is not circulating. But I think there's also an optimistic side where we are seeing the rise of the new economy.
Okay.
And this is a topic I've really been spending a lot of time on.
Okay, please elaborate. What's the new economy?
The new economy is a shift towards more digitally enabled, technologically underpinned economies.
Okay.
So the traditional...
That's a mouthful. Take it out. Take it back. Rewind. So what is the new economy?
So the old economy was really around the industries.
Yes. No. I want you to repeat what you just said. I think it's a catchy phrase. So the new economy.
It's anchored on digital platforms.
Yes.
And it's highly leveraged on technology, and more fundamentally, it's a knowledge economy.
Okay.
So it's the exchange of knowledge.
Exactly.
And it's a big shift from the previous old economy, where it was really around the manufacturing of physical goods and services. And this is not to say that that will not continue, but we are seeing the rise of the digital economy, where we are seeing events happening online.
Okay.
We are seeing habits in terms of how people are conducting learning, how people are transacting online, how people are marketing their goods on social media, and that. You know, I was just talking to an Uber driver yesterday, and he told me the lady who owns his car, he's not seen her physically since January. Okay. All they do is M-Pesa and they WhatsApp each other. And WhatsApp each other. Even no calls, actually. It's just, this is what needs to be done. That's What's going on. Okay. And he sends her the money she needs. And it's December 1st today. So it's a whole year they've not had any physical interaction. And this is one characteristic of the new economy, where physical interfaces are really reduced. And everything is happening on these platforms of M-Pesa, social media. So it's an exciting time for innovators, people who can create platforms that can leverage on that. So I think that might be the flip side of what we are going through right now. All right. So I was going to ask, even as you are defining the new technology and the substance of technology, what happens? Because if we all move in, or most of the businesses move into the knowledge share, then how are we applying this knowledge? How do we look at our economy maybe in the next 2 to 3 years, based on your own analysis and the emergence of the new term, the new economy, from your perspective? Well, if you look at the Kenyan economy, our competitive advantage is on human capital. Yes, it is. It's on people. And this is opposed to like Tanzania, which is heavy on natural resources. I mean, they do have a human capital, but they also have deep reserves on natural energy, natural gas. Kenya, really, it's the human beings really that drive the Kenyan economy. Even our diaspora remittances have overtaken the coffees and the teas. Yes. So for me, the knowledge economy will lend itself very well to the Kenyan economy, which is already a knowledge-based economy. So it's just a matter of moving these platforms to the online space. We have the digital payment platforms that exist. Fintech is vibrant. Exactly. Our internet connectivity is vibrant. So we are going to have a whole economy that's taking place online. And for me, I think it's going to really trigger a lot more innovation and really will bring out the best of Kenyans. Do you know what I hear you saying, Ken? There was a huge trade yesterday on Safaricom, 23.7 million shares traded at 32.7. When I listen to you, I just keep hearing you saying that, Bithe, perhaps 32.7 is not a bit of a stretch in terms of price, but that's a conversation for another time. So thank you so much for just giving us an overview of the economy and some of the emerging trends that you see from where you stand. Now, let's come back to the macro, the macroeconomic view of Kenya as a country. Debt is a big problem. We've briefly covered GDP, but debt is becoming an issue. Is it a looming crisis? Is it something to be worried about? When you have 58% of your taxes going to service debt, if 58% of your paycheck is going to service a loan, there's a problem. There's a big problem. And it's unfortunate that sometimes our leaders tend to compare the US and Japan that have over 100% debt to GDP, Japan 200%. What they forget is those two countries borrow in their own currency. The US will borrow in dollars, Japan borrows in yen. As long as you borrow in your own currency, then you're not really in a big, because you can always print your way out in the worst case scenario. Exactly. What we have in Kenya and other African countries, we have dollar denominated debt, like Zambia, Kenya, all these countries, the last 10 years, they've been taking up Euro bonds over the last 10 years. So we have dollar denominated debt. Now that means your reserves have to be very strong. Your diaspora remittances need to come through, your tea and coffee. You are dependent on what's happening beyond your borders. Your destiny is out of your hands. You cannot
that's
print
not a
your
good
way
place
out.
to be, even at an individual level.
Exactly, and that's the dangerous thing. So yes, it's not the 100% that you see in Europe, but 58%, but a big chunk of it is in dollar-denominated debt, puts us at the mercy of the global forces. And you never want to be in a situation where your destiny is out of your hands.
Okay, so 58%, how does that compare to the rest of the continent? But more importantly, how have we got into 58? Where were we maybe a year, 2, 5 years ago?
Well, definitely the big thinking around the big infrastructure projects has gotten us here. And part of the big facing east agenda has been on the mega infrastructure projects. And I don't want to belabor the points of the SGR,
okay.
But those
and
really...
the roads.
And the
I mean,
roads.
I've even noticed that we built roads and then now we're putting them down. Okay.
Precisely.
Building again.
And it's really an overemphasis on fiscal policy. But what I've been trying to remind players in this market, it's monetary policy that really drives growth, prosperity.
And that's central bank and the cost of money, interest rates.
Precisely.
Okay.
In fact, when you go to the States or to Europe, the first person to talk about the economy is the Fed Reserve. You almost never hear the U.S. Treasury Secretary.
Actually, we
saying
never
much.
hear.
You don't
That's
even
very
know
true.
who he or she is, but everybody knows Ben Bernanke. Everybody knows Janet Yellen.
Exactly.
And for Africa, it's very unfortunate that it's the ministers of finance who are head of fiscal policy who take really the face of the economy, but it should be the central bank governors. And if I was to ask you to name the central bank governors around Africa, you might not...
Like probably no Kenya, Nigeria, and
exactly.
Uganda, and it's a wrap.
So it shows me that monetary policy is lagging behind.
Yeah.
We are still caught up in these big government spending infrastructure projects, which is okay in terms of it can open up an economy by creating easy transport and such, but it really, especially when issues of corruption are not too far away,
Yes.
a lot of that debt money doesn't necessarily have to go into projects.
Okay.
So it's very easy for that money to disappear. Talk about the Eurobond too, where we still a lot of things that a lot of conversation around there. So for me, I think it's just remind us that we need to look at monetary policy. We need to give it the space that other countries have given it in terms of its supremacy.
Okay. Just before we take a break, I want just to ask one key question. When you said that the element of the debt that the country has incurred has largely been spent on infrastructure. Now, I want to bring that conversation back to you talking about the new economy. At times when I analyze the economy, I get the sense that possibly our fiscal spend and our mindset, we want to put money in the economy, we want to give jobs, and we're building roads, and there's all this brick and mortar. But the opportunities in the new economy and the technology and the infrastructure. And today in Kenya, when it comes to technology, you only have one company, more or less, that's spending a material sum in terms of expending. But you don't get the sense that the government is pushing into that. So are we having the right kind of development expenditure? Is there an opportunity to leverage on the new economy?
I think you're an economic genius, Bita, because you've been able to see the contradiction between our fiscal policy, which is, as you say, is on roads and railway and bridges and dams, but the real opportunity is in the new economy, digital spaces.
Okay.
So if we really wanted to play fiscal policy the proper way, we should be investing more in digital infrastructure, getting everybody connected. You know, that laptop program was supposed to get every kid connected, so everybody is coding and writing and really doing stuff.
Wow.
So it shows you that there's a major disconnect. But a lot of people say that, you know, these projects in road and railway, they still have their place, but I worry a lot, especially when we've still not yet fully been able to tame corruption.
Okay.
And that. So for me, I completely agree with you that if we need to talk about infrastructure, we need to talk about digital infrastructure, because that is what will connect us to the rest of the world, because people are not traveling as much as they used to. People, yes, COVID might go away, but we're going to have this hybrid model where things will be part virtual and part physical, and we need to have that digital infrastructure in place. So I think a complete digital transformation of the government, the ability to, you know, what they had started with the Huduma numbers, you know, where you could get everything online, we need to sort of expand on that and make sure that everybody can get these things very quickly.
All right, thank you so much for the kind compliment. We take a short break. When we come back, we continue to explore the Kenyan economy, looking at debt. We've just found out how did we get here and are we doing the right things now? We want to look at the extent of paying 58% of our revenues each and every single, at least for this year, paying that out into debt. What does that mean, and what does that effectively mean for the investment case for Kenya? We take a short break. When we come back, we continue with this conversation.